This is the ultimate guide on exactly when to sell your crypto. I have studied every major bull run, compared patterns across multiple market cycles, and boiled it all down to the handful of signals that show up every single time before the top. And this year, with crypto just now heading toward its most explosive phase yet, the timing couldn't be more important. In this video, I'm going to break down every historical sell signal that pops up in previous crypto cycles. And as we get into the signals, I'm also going to be bringing in the perspective of one of the most respected macroeconomic experts in the game, Raoul Pal. He's a former hedge fund manager, founder of Real Vision, and the man whose cycle analysis has guided some of the biggest players in crypto. When Raoul talks about when you should be selling, people listen. Now, here's the thing. No one single signal to sell is perfect. What matters is when sell signals start to pile up. If you've got 4 or 5 sell signals flashing at once, you're looking at the kind of market euphoria that almost always ends the same way. So let's break it down. First, we need to talk about the 4-year cycle. As you know, crypto since the beginning has ran on a fairly predictable 4-year cycle. Here's Raoul Pal explaining why.
So as we know, crypto is very cyclical. There's a debt refi cycle that happens every 4 years because everybody reset their interest rates in 2008 to 0 and then made all of the government debts in around 4 years, 3 to 5 years. And it's created this endless cycle, which happens to be the same as the Bitcoin halving cycle and the US presidential cycle. So we're faced with these cycles. And out of 3 years, crypto is the best performing asset in the world. In year 1, crypto spring, year 2, crypto summer, year 3, crypto fall, and macro spring, summer, fall. And then year 4 is the worst. And the worst is what scars people.
Every major crypto bull run we have had has fit neatly into a 4-year rhythm, tracking almost perfectly with Bitcoin's halving cycle. In 2013, Bitcoin went from under $1,000 to $1,200 before collapsing. In 2017, it blasted to $19,000. In 2021, it peaked near $69,000. Each peak happens roughly 4 years after the previous one. If the pattern holds, we would predict the top of this cycle should hit between late 2025 and early 2026. Raoul Pal backs this up with his own everything code thesis. He points out that the Bitcoin cycle lines up almost exactly with a debt refinancing cycle that's been in place since 2008, the US presidential cycle, and the halving schedule. All of this is baked into macro liquidity flows. In his seasonal view, year 1 after the halving is crypto spring, year 2 is crypto summer, year 3 is crypto fall, and year 4 is the crypto winter, the brutal bear market that wipes out the over-leveraged and the overconfident. According to his model, right now we're in crypto summer, the phase where prices accelerate, corrections get shallower, and the market starts behaving irrationally on the upside. The next phase is crypto fall. That's where leverage explodes, retail piles in, and parabolic gains push us into the peak. Since it's already August 2025, the clock is running down. Pal believes this cycle still has the potential to extend into 2026, with the peak possibly landing in the first half of the year. That's the period you should be planning around right now. As that window approaches, one of the earliest and most reliable signs of a market entering its late bull market phase, what Pal refers to as crypto fall, is already appearing. This is the period when gains have been strong for months, confidence is high, and traders start taking on far more risk to amplify their returns. It's a pattern seen in every cycle before the peak, and it almost always comes with a surge in leverage. Maxed out credit cards, personal loans, even home equity are being pushed into crypto, and we're already seeing people online brag about going all in on dips with borrowed funds. But this kind of behavior is gasoline on a fire. It accelerates gains but leaves the market dangerously fragile. The moment prices slip, lenders call in that debt, forcing sales that turn a routine pullback into a cascading sell-off. If this trend grows over the coming months, it will be a strong sign that the peak is near. And before we move into the exact profit-taking framework to follow, just a quick reminder, only a small percentage of you watching are subscribed. If you're getting value from this breakdown, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's get into another classic signal, the moment when the market convinces itself that the fundamental rules of cycles, liquidity, and human behavior no longer apply. In every cycle, investors tend to develop a polished, sophisticated sounding reason why the next bear market will never come. This time, the story is that institutional adoption through ETFs will keep prices stable, that pensions and endowments are long-term holders who won't sell, and that crypto will now behave more like the S&P 500. But institutions aren't immune to market forces. They still have risk mandates, liquidity needs, and political pressure. If conditions tighten, they sell, and they sell big. Claims that deep drawdowns are over should be taken as a warning that the market is near a peak. It's often accompanied by more visible retail mania. One of the simplest, eeriest patterns in past cycles has been the rise of Coinbase in the Apple App Store rankings in both 2017 and 2021. Coinbase hit number 1 within weeks of the crypto market peak. Right now, in August 2025, it's already climbing fast. If it takes that top slot in the coming months, treat it as a siren warning that we're close to the edge. Another classic signal that the crypto cycle is nearing its peak is capital rotation in the crypto market. What happens is simple. We first see Bitcoin run hard, then we see Ethereum run hard, then we see money flow into altcoins and further out on the risk curve. Right now, we are seeing Ethereum run hard and capital rotation deeper into the risk curve is already well underway. Bitcoin, Ethereum, and most other large cap coins have already had their breakout runs, capturing the bulk of early cycle attention and delivering strong gains. Once that phase plays out, history shows what tends to happen next. Liquidity starts flowing into smaller cap altcoins. These are the coins with thinner liquidity, higher volatility, and the potential for huge percentage moves both up and down. The next step in this progression is what seasoned traders call Ponzi season. This is when the absolute lowest quality projects, often with no working product, no sustainable business model, and in some cases outright scams, start producing the largest percentage gains in the market. In 2021, it was unsustainable DeFi projects, passive income coins, and yield farming projects promising thousands of percent returns. These lured in traders who didn't want to miss out, only to collapse shortly after. Remember the collapse of Luna? Expect the 2025 version of Ponzi season to arrive before year end, powered by whatever narrative captures retail imagination this cycle. Whether it's AI-driven tokens, celebrity-backed meme coins, or flashy next-gen staking models. Once it begins, you're looking at the last and most dangerous stretch before the blow-off top. The gains can be spectacular, but they're usually the market's final burst of euphoria before the inevitable reversal. Market culture also changes during crypto fall because it's the stage where speculation starts to overshadow substance. The loudest voices aren't the developers or long-term builders anymore, but the flashy traders and meme coin promoters flaunting cars, vacations, and watches. Narratives get replaced by entertainment, and the focus shifts from what's being built to who's showing off the most. You'll see it reflected in conversations beyond crypto Twitter. When people with no prior interest in investing, for example, your Uber driver, your cousin, your dentist, start giving you token picks, it's the social proof of peak FOMO. In every previous cycle, this everybody's in moment has landed dangerously close to the top. Celebrity endorsements push it even further. When athletes and musicians start launching coins, NFTs, or attaching their names to blockchain projects, it's usually not the start of something new. It's the marketing climax, and by then, almost everyone who can be onboarded already has been. Institutional behavior also shifts in ways that are easy to spot. Venture raises start looking ridiculous, with early-stage projects pulling in hundreds of millions on little more than a white paper. In 2021, it was smart money doing it, but this late in the game, it's deep-pocketed capital chasing the few remaining opportunities. The retail crowd matches that energy with emotional over-attachment, people tattooing coin logos, NFT avatars, or project slogans on themselves. These cultural markers tend to cluster within months of the top. Alongside all this, the way people interact with their portfolios changes. Checking balances once a week turns into dozens of times a day. That behavior is a direct reflection of greed and emotional trading. And when it becomes widespread, it means the market is being driven by feelings rather than fundamentals. Projects mirror that overconfidence with excessive marketing spend, stadium naming rights, primetime commercials, over-the-top sponsorships. Even search data starts to give away the mood. A spike in cheap crypto to buy searches on Google Trends means that most rational plays have already run their course and the crowd is hunting for scraps. Now, let's talk about some powerful cycle top indicators. For those who follow technical indicators, one of the most widely respected is the pi cycle top signal. It's a simple but powerful concept. When Bitcoin's short-term trend, represented by the 111-day moving average, crosses above its long-term trend, represented by the 350-day moving average, it signals that the market is overheating. This crossover has a history of precision that few other indicators can match. In 2013, it fired almost at the exact peak of that cycle. In 2017, it flashed within a couple of days of Bitcoin's $19,000 high. In 2021, it did the same, sounding the alarm right before this sharp drop from near $69,000. The reason it works so well is that it captures the point where short-term momentum becomes unsustainably high compared to the long-term baseline. As of August 2025, that crossover hasn't happened yet, meaning the market hasn't reached that historical overheating threshold. But history suggests that when it does, it will come late in the mania phase, a point where many of the other warning signs, from retail euphoria to institutional overconfidence, are already flashing bright red. In other words, the pi cycle top won't be the first warning, but it's often the one that confirms the market is approaching its breaking point. Now, once some of these classic sell signals start flashing, it begs the question, how should you think about selling? Well, to answer this, here's another clip from Raoul Pal.
Here's my suggested path for most people, and maybe something I will do this time myself, is we don't know what the cycle peak is going to look like. We don't quite know when it's going to be. We do know it would be crazy early if it finished this year. Usually the back part of the year after the US election, there's usually a screaming pump into the end of the year. So my advice is use that in terms of time and not price, and take maybe a third off the table for lifestyle chips. Okay, now you can buy your car or your house if you're lucky, or whatever it is, or some extra savings, right? Take some money out of crypto land, put it into fiat world where you live, secure your lifestyle, the things that matter to you. Right, now you've taken all of the pressure off. You've done it via time and not price, which is towards the end of the year, I'm going to take a third off. I don't really care what the price is because it will be up a lot. So I'm just going to take it off. And then now I've de-risked my life so I can now run 2025 more intelligently.
The final and most difficult market to act on is when selling feels completely wrong. Your gut says hold, everyone you follow is bullish, and the news flow is euphoric. Pal's advice here is simple. That's exactly when you should think about selling. The point where selling feels insane is often the exact point when it makes the most sense. All of this feeds into Pal's 2025 exit playbook. His core message is that trying to nail the exact top is a trap. Most people sell too early or never buy back in. Instead, he suggests thinking in time windows, not price targets. For this cycle, he's looking at the period from late 2025 into early 2026, with history showing that the most explosive gains often come in the back half of the year before the market flips. His personal strategy is to take roughly 1/3 off the table for lifestyle chips within that window, no matter the price. That locks in life-changing gains and removes the emotional pressure. He then keeps 2/3 running to capture any final vertical moves, with the option to take another chunk off if we see a mega pump like late 2017. Crucially, he never fully exits. Holding a core position ensures you're not sitting in cash when the next cycle starts. Pal's own history shows why this matters. Back in 2013, he sold near the top and tried to time his way back in, but if he had simply held that original position and added more during the deepest bear market drawdowns, his returns would have been roughly 25 times higher. In assets with exponential adoption curves like Bitcoin, the compounding effect of holding a core position and buying at extreme lows can far outweigh the short-term gains from selling tops. Missing those explosive up years because you're sitting in cash can quietly destroy long-term performance. Right now, in August 2025, that means putting your plan in place while there's still time. Start tracking multiple top signals instead of waiting for every single one to flash at once. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. From there, define your exit window. For most people, that's November 2025 to February 2026. Set your lifestyle chip number in advance so greed doesn't talk you out of acting, and start preparing cash for 2026 when the bear market will hand you the kind of discounts that set up the next wave of wealth creation. We're heading into the banana zone, the phase where gains go vertical, then vanish faster than you think possible. So watch the signs, respect the cycle, stick to the plan that keeps you in the game for the long term, and remember, tops are built on euphoria, and euphoria always feels safest right before the fall. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.